Hello and welcome back. About halfway through 2023 now, I think it was time to have a closer look at venture capital. Let's start off with the perspective of the venture capital funds and the LPs, meaning the investors in the fund. As we all know from my earlier sessions, venture capital has always been about outliers. What does it mean? That means in early stage investing, seed and round A, expect about 8 out of 10 investments not returning the money invested. So that means a very small number of investments will be responsible for 50 to 60% of the outcome in a venture capital fund. So, having said that, let's have a look at what happened in 2022. Remember, until 2021, venture capital had been through an exceptional time. We saw record investments being made on a global scale, and that started tapering off in 2022 already. Now, we will wait for the final data on the first half of 2023, but already now it is clear that we will see further tapering off around the world, independent on the region where we are in. Now, fundraising as well in 2022 was significant, surprisingly, surpassing even 2021's explosive growth. Nevertheless, that meant during the first half of 2023, we already saw a drastic tapering off that started already in the last quarter of 2022. So fundraising has been tough in venture capital. Nevertheless, given the record amounts of money raised in the last 3 years, more dry powder now is available in venture capital than has ever been before. Right now, nevertheless, it is not being deployed. So the first half of 2023 definitely saw a cautious approach by VCs to investing and deploying of funds. Now, how about those exits? Now, this is quite a scary chart when you see where we came from in 2021, where we saw record investments quarter on quarter, record exits quarter on quarter, and already 2022 saw a plummeting of those exits. What does it mean? That means when VCs did not return money to their LPs, their institutional investors. That also means that those LPs are right now in a negative cash flow environment. Now, let's have a look what that means for implications for VCs and for their investors. Number one, for the VC funds. There will be no more mega rounds going forward, i.e. large rounds invested in later stage startups. VCs will spend more time on the road fundraising. That means also we will not see fundraising happening within 2 years of successive funds. Longer time spent on the road, more time spent deploying those funds. And obviously VCs will continue to focus on their existing portfolio companies instead of making new investments. That will have implications for our next conversation for the entrepreneurs. For the LPs, nevertheless, this is not all bad. Secondary transactions in future will be attractive. So getting basically exposure in past vintages where one potentially couldn't get access to in the last few years. So for the LPs, it's time for bargain hunting. Low valuations will make this particular vintage certainly attractive in future, and LPs are well advised to pay attention and ensure that they get exposure to this vintage. Thanks very much, and I will see you again for our next section where we talk about implications for entrepreneurs.